Welcome to vTalkInsight, Market Drivers Daily for January 28th, 2026. Trade frictions, AI-driven rallies, and persistent geopolitical tension are colliding in markets today, shaping where growth, inflation, and risk premia are heading next. Let us start with how the latest trade moves are rewiring global flows and sector leadership. Global trade policy is pulling in two directions at once. Escalating tariff threats from the United States are colliding with large new trade agreements that open markets and redirect flows. That tension is increasingly important for how sectors perform, how sticky inflation proves to be, and which regions can still find export growth even as traditional trade routes become more politicized. A pivotal development is the newly finalized free trade agreement between India and the European Union, concluded after nearly 20 years of talks. It will gradually strip tariffs from over 90% of EU goods exported to India, signaling a structural deepening of economic ties. Tariffs on European cars sold into India are set to fall dramatically from around 110% toward roughly 10%, while duties on car parts will be phased out entirely over about a decade, materially changing the economics for European automakers. European exporters in autos, machinery, chemicals, pharmaceuticals, and agriculture look positioned to benefit as Indian tariffs fall, with estimates pointing to around $19 billion of additional EU exports and a modest lift to EU growth. India, in turn, could add roughly $50 billion of exports into Europe, so the agreement works both ways and helps both sides offset part of the drag from earlier U.S. tariff measures, rather than simply shifting dependency from one partner to another. Set against this liberalization, the effective U.S. tariff rate has climbed to around 12 to 13%, eroding some of the classic gains from global trade and posing particular challenges for export-driven economies. President Trump has threatened tariffs of 25% on a wide range of South Korean goods, from autos and lumber to pharmaceuticals, and has also aired potential actions against Canada and Europe. Yet since 2024, only about 27% of threatened U.S. tariffs have actually been implemented, a track record that helps explain why markets often fade the headlines. South Korean assets are a case in point. Despite repeated tariff threats, the Kospi has shown resilience, recently reversing early losses to finish up about 2.7%, with AI-related names leading the rebound. Corporate behavior tells a similar story of adjustment rather than collapse. Evidence suggests U.S. importers have absorbed most of the tariff burden themselves, hitting domestic margins rather than foreign supplier profits, while export volumes from tariff-hit countries like India and Brazil have declined even when prices held steady. Those shifts carry clear inflation and earnings implications. Tariff-related cost pressures are expected to build through the first half of the year as more companies pass higher input costs to end consumers, adding to existing worries about a renewed inflation pulse. U.S. automakers, with annual sales still around 16 million vehicles and average new car prices above $50,000, face a growing trade-off between protecting volumes and preserving margins. General Motors has so far offset higher tariffs through efficiencies and production choices, but the scope to keep shielding consumers looks increasingly constrained. For portfolios, the result is a split narrative. On one side, new agreements like the EU-India deal offer alternative growth corridors for sectors such as European autos, wine, and luxury goods, partially compensating for U.S. tariff headwinds. On the other, a higher global tariff baseline and the risk of a full 25% levy on South Korean goods still hang over export volumes and price dynamics. Key watch points now are ratification and implementation of the EU-India agreement, any concrete follow-through on U.S. threats toward Korea, Canada, and Europe, and how quickly tariffs surface in earnings across autos, logistics, and luxury. Notably, some of the strongest equity gains in Korea are coming from AI-related stocks, which highlights how technology is reshaping the market narrative beyond trade frictions. Across global equities, AI remains the dominant performance engine. often overpowering geopolitical noise and tariff headlines. The backdrop is a macro environment that still looks supportive, with solid growth, broad fiscal expansion, and the AI theme in what many see as an early expansion phase, encouraging investors to maintain a pro-risk stance even as policy uncertainty rises. Fixed income and macro teams are now building in sustained growth partly off the back of AI and associated capital spending, with some internal forecasts for 2026 GDP around 2.5%, slightly above prevailing market consensus. Mega-cap tech firms are central to this story. They are spending heavily on data centers, chips, and networking, yet still expected to generate substantial free cash flow, and their growing weight in credit indices is reshaping how investors gain exposure to corporate balance sheets. Recent company news highlights where AI benefits are crystallizing most clearly. Micron plans a $24 billion investment in Singapore to expand memory chip capacity tied to AI demand. While SK hynix surged after reports it will be the exclusive supplier of advanced HBM3 memory for Microsoft's AI hardware. Corning's multi-year agreement worth up to $6 billion to supply Meta with optical fiber solutions underscores how data transmission and connectivity are also leveraged to this build-out, alongside power generation and key commodities. Competition inside the AI stack is intensifying. Microsoft's launch of the Maya 200 AI chip, which it claims outperforms some rivals on specific tasks, adds another in-house alternative to existing offerings from Google and Amazon. At the same time, China is making rapid progress with models such as Moonshot AI's Kimi 2.5 and Alibaba's Qwen, even if they still lag leading U.S. systems. NVIDIA executives are in China seeking approval to sell the H200 chip, and while China is currently a smaller market for the firm, regulatory clearance could turn it into a more meaningful growth driver over time. This capex wave brings its own questions. Investors are closely examining whether large AI-related spending by companies such as Meta will translate into higher advertising revenues and new platform growth, and how quickly that payback might arrive. Despite an 11% rally on more upbeat analyst sentiment, Meta's share price remains down since its last earnings release, reflecting uncertainty about the ultimate returns on aggressive infrastructure and AI investment, and adding to broader concerns about valuation and concentration risk around a handful of megacaps. On the macro side, AI-driven productivity gains are widely viewed as a potential long-term support for global growth, with some expecting them to counter fears of widespread job losses. So far, the evidence is mixed. Immediate earnings benefits are concentrated in infrastructure and semiconductor names, while many large tech companies have relied more on price increases and headcount reductions than on transformative AI efficiency gains. The broader economy shows a K-shaped pattern. AI and even sectors like gambling are growing with limited labor needs, while many consumers see wage growth barely outpacing inflation. Policy choices are becoming a meaningful swing factor for the AI trajectory. The U.S. government is intervening directly across the AI supply chain, from chips and semiconductors to critical minerals, signaling an activist industrial policy, yet moves to restrict H-1B visas and raise their cost may undercut domestic AI capacity by limiting access to global high-skilled talent. Meanwhile, advances in AI and data science are democratizing access to alternative data. Institutional investors are increasingly using AI-driven sentiment analysis on social media to extract early signals, and the integration of real-time data into trading strategies is expected to become more efficient and widespread over the next 5 years. Counterarguments focus on timing, sustainability, and policy risk. Enterprise AI adoption is still in early innings. Current quantum computers do not yet outperform traditional supercomputers on large problems, and some see a risk of circular financing and stretch valuations if earnings do not keep pace with the hype. On the positive side, current data do not support fears that AI is extinguishing creative or humanities-focused roles, and there is evidence of both job creation and destruction, especially around data centers. The next catalysts are earnings from major AI-linked firms like Meta, Microsoft, and Tesla, along with central bank decisions that could influence discount rates on long-duration tech cash flows. These will help determine whether AI can keep offsetting trade and geopolitical shocks in equity markets. Geopolitics remains a central macro overhang, but the narrative has shifted from isolated shocks to a more structural reshaping of alliances, energy security, and capital flows. Recent days have seen an emphasis on strategic autonomy, especially in Europe, and that theme continues as countries seek to reduce single-country dependencies while managing elevated conflict risk and political volatility. The new India-EU trade agreement is not just about tariffs. It is also about reducing strategic dependence at a time of rising trade and security frictions. Alongside fresh EU deals with Mercosur and Latin America, and the UK government's efforts to balance its close U.S. relationship with deeper business ties to China, this points to a gradual diversification away from over-reliance on either Washington or Beijing, even as Europe reassesses how it engages its U.S. alliance. Energy is a key channel for these tensions. Europe now sources roughly a quarter of its gas from U.S. liquefied natural gas, increasing its exposure to shifts in American policy even as it has reduced dependence on Russian pipelines. European benchmark gas prices are up about 40% so far this year, driven mainly by weather-related demand and some geopolitical strain. The global LNG market is highly flexible, allowing cargoes to be rerouted quickly, which makes gas a less effective geopolitical weapon than fixed pipelines, but does not eliminate price volatility for energy-intensive industries. Financial markets are expressing this uncertainty through safe haven demand and currency risk premia. Gold prices remain elevated above $5,000 per troy ounce and have recently rallied about 1.5%, helped by a weaker U.S. dollar, concerns about currency debasement, and ongoing geopolitical risks. Some forecasts now contemplate levels as high as $7,000 by year-end, supported by central bank buying and investor diversification away from sovereign bonds and currencies. At the same time, political rhetoric about currency devaluation by China and Japan is increasing, but the U.S. dollar still benefits from its reserve status and the depth of the Treasury market, limiting the practical impact of short-term sell American narratives. Policy signals add further complexity. The U.S. administration has suggested that security guarantees for Ukraine could be contingent on Kyiv accepting a peace deal involving territorial concessions, a stance that heightens uncertainty for European security and Eurozone risk premia. The European Central Bank is emphasizing full optionality, ready to respond quickly to geopolitical and trade-related shocks, while sectors such as airlines and luxury goods are already flagging operational and demand headwinds from disruptions and fragile sentiment. At the same time, the rise of populism in Europe is increasingly seen as less threatening to EU cohesion, as governments often adopt more pragmatic stances once in office. For investors, this produces a complex risk balance. Safe haven assets like gold and silver are in demand. Strategic stockpiling of minerals is creating a multi-year tailwind for parts of the metals complex, and currencies like the Australian dollar are favored in some views for their relative insulation from direct geopolitical flashpoints. Countering that, the flexibility of LNG flows limits the effectiveness of energy as a geopolitical weapon. The cost of hedging can be high, and, as we have seen in past shocks, a severe liquidity event could even force some investors to sell precious metals. Key watch points now are developments in Ukraine diplomacy, further details on EU defensive economic tools, Eurozone energy pricing through the next weather cycle, central bank gold purchases, and how FX markets price geopolitical risk into the rest of the year. Across markets, the picture is one of tension but also adaptation. Trade policy is fragmenting. Yet new agreements, such as the EU-India deal, are opening fresh corridors for growth. AI continues to anchor equity leadership and support the macro outlook, even as questions around capex payback, labor impacts, and valuation build. Geopolitical risks remain elevated, feeding safe haven demand, energy volatility, and FX risk premia, but flexible supply chains and pragmatic policy choices are helping to cushion some shocks. Monitoring tariff implementation, AI earnings and capex guidance, and evolving geopolitical flashpoints will be critical for understanding how risk and return trade-offs shift from here. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.